Welcome to Financial Strategies with Andrew and Daniel Agemy, powered by the Retirement Income Store and brought to you by Agemy Financial Strategies in Guilford, Connecticut and Denver, Colorado.
AAA, I was talking to somebody the other day and going through a whole story about how they have this friend who works at the same company as them. They've been investing into their 401k for 3 years now. And they're telling him how they're doing so well. They're doing so well. You know, they keep saving money and how it's accumulating and doing well. Turns out 3 years later, the guy says, wait, I haven't made anything. You have to choose investments in your 401k plan. It doesn't automatically get invested. I'm Daniel Agemy.
And I'm Andrew Agemy, and you're listening to Financial Strategies with Andrew and Daniel Agemy. We're glad to have you with us this week. Today's topic is IRAs versus investments. And Daniel, that's a great example of what we're talking about today because, people get confused with IRAs, 401ks, Roth IRAs, rollover IRAs and investments. They're two different things. So that's what I'd like to be able to educate our listeners on today, and glad to be able to do this with you today. That's crazy. A lot of times people don't get the idea that there's a difference between investment vehicles and registrations, right? The 401k is a plan, and the IRA stands for Individual Retirement Arrangement. I believe if you look up in the publication, the IRA's publication, it says a lot of people think IRA stands for Individual Retirement Account. Well, it's actually Individual Retirement Arrangement, and it's this arrangement that's used to tell the rules for what happens in the event of life, in the event of death. Who gets it, who owns it, who's going to be taxed on it, all these different kinds of things. I mean, what do you say?
Well, we hear it a lot. People will say, how much are IRAs paying today? Or, this saver was putting money away and felt like it was accumulating because he was saving. And that's a myth that happens with these 401ks. People put money into their 401ks and it accumulates. Why does it accumulate? Well, two reasons. One, because markets have gone up over time. And when you're able to participate in dips without thinking about it, it's able to accumulate. The other is because you have money coming out of your paycheck every week or every other week that you don't even miss, that you don't even think about. And so those are two things, right? It's kind of forced savings, putting money into these things. Another situation where somebody said, hey, I've got this IRA and I'm investing, or this 401k and I'm investing in it, but it doesn't seem like it's building up at all. And we looked at it and they were investing, but they also didn't pick an investment. And it was going into the default fund, which had a 2.25 BlackRock fund. 2.25 isn't how much you earn. 2.25 is the fee they are charging you. So if you didn't default to another fund, people talk about, you buy the Vanguard S&P fund and there's no fees. It's 0.01% or something like that. Well, if you don't pick, you get BlackRock, and BlackRock charges you 2.25. You got to make a lot of money to overcome a 2.25% fee, right?
Yeah.
So we want to talk about the difference between these investment accounts or arrangements, these ways of holding your money, and the investments you can buy inside of these arrangements or these accounts.
Right. Exactly. And, the way I like to describe it is like, motor vehicles, cars, trucks, those kinds of things. And, a truck, if you have a car or truck, you have a license plate. The license plate represents the piece of paper that's in the glove compartment. That's the registration. And that license plate, let's say it's number 1, 2, 3, 4, 5, 6, can be moved from a Ford to a Chevy to a Toyota or whatever you want to do, different motor vehicles. And the license plate, the registration represents who owns the vehicle, who gets it in the event of death, who has to pay the taxes on the vehicle, all those kinds of things. But as far as the performance of the motor vehicle, it depends upon what kind of motor vehicle you put that license plate on. You could put it on a 2023, a plumb crazy Challenger with a shaker hood and a 6-speed transmission wide body, or you could put it on a Volkswagen. And the performance of that motor vehicle is going to be dependent upon the motor vehicle, not upon the registration of that motor vehicle. And so same thing when we're talking about 401ks, IRAs, Roth IRAs. Those are registrations, those are license plates that you can put in different kinds of investment vehicles. And how well the Roth IRA does, like you said, Dan, we often get asked, how well do IRAs perform? Well, it's dependent upon how the money is invested, what kind of investment vehicle you use in regard to that. And so that's what we want to make sure that people are having clarity on. Again, for the various types of IRAs. And so, you got 401ks, 403bs, 457s are all different kinds of employer-sponsored plans. It's your money that goes into those, but the plan belongs to the employer, and they're the ones in control. They're the ones that determine how you can, what options you have available to you. Then you have IRAs, traditional IRA. Well, you have traditional IRAs, you have non-deductible IRAs, you have rollover IRAs, and you have Roth IRAs. And they're individual retirement arrangements, which allow you to determine the universe of options of how to invest monies. And one of the beautiful things is that most often at 59 and a half, the government takes off those handcuffs that have been on you so that you can then say, well, I want to move my money from my 401k or 457 or whatever it is into an IRA so I can invest it in the way that I want to, because I'm close to retirement as opposed to being a young person who's just starting out. Well, if you just joined us, you're listening to Financial Strategies with Andrew and Daniel Agemy, and we're glad to have you with us today. Today's topic is IRAs versus investments. And we've got a lot to go through and talk to you about today. And we have a paper that we'd like to give to you that goes along with today's show called Hard Lessons in Stock Market History. Hard Lessons in Stock Market History. So we'd love to be able to put that in your hand for free, no obligation. Just call us at 800-725-7616. 800-725-7616, or contact us on the web at our website, agemy.com, agemy.com, and ask for the paper Stock Market History. Glad to get that out to you. Today's topic is IRAs versus investments. You listen to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. Daniel, so I love that illustration between the investment vehicles and motor vehicles. I think that's such a cool way of being able to describe it personally, and to being able to take that license plate from one motor vehicle to another. And same way you can put different kinds of investments. You can put real estate into IRAs or Roth IRAs. You can put bonds, stocks, all kinds of things. Unfortunately, most people are using mutual funds. A lot of people are using mutual funds, but there's a myriad of things going on there.
Yeah. So the account, or in your scenario, the registration or the license plate, is the way that it's registered. So some could be pre-tax, some could be after tax, some could be tax-free. And you put your money into that, and it holds the money for you. That's the first part. So most people are able to participate in a 401k or a 403b. And that license plate, that registration, that account has its own parameters, right? So if it's a 401k, there's going to be the rules that 401k plans have from the IRS, and then there's going to be rules that your company puts upon you. And you want to participate in some type of investment. Right. You put the money into the plan, unless it's defaulted to go into some kind of mutual fund or ETF, it just goes and sits there and doesn't do anything until you pick the options that you have available to you for your money to go into. There's usually a whole bunch of options that people could have go into those. Now, we need to get into a little bit the different types of investments, because An ETF is a product, not necessarily investment. It's a way to participate in investments, right? A mutual fund is a way to participate in investments. Why is that? Well, an ETF is a wrapper, and you can own things inside of the ETF. You don't own them. The fund, BlackRock, owns them.
Right.
And you own a claim on the things that BlackRock owns through that ETF, right? So you could use that ETF to buy real estate, or you could use that ETF to buy bonds, or you could use that ETF to buy stocks or international. And sometimes you have to use ETFs, right? Because you can't go pick individual stocks in, India, right? There's a few that are maybe listed on the US stock exchange. Without an account in India, you can't go pick stocks that are not listed on the US without having a special account to do that. But you could buy an ETF that owns Indian stocks.
Yeah.
Right?
Yeah.
So an ETF is designed to make it simple for participating in different types of markets or different types of assets. You might not want to go buy an apartment building, or you might not be able to buy an apartment building in your 401k, but you could buy an ETF that buys apartment buildings.
Right.
The difficulty is a lot of times in the 401ks, you're not even able to buy those types of ETFs because they're very limited on, international exposure is very specific to this, or stocks are very specific to this. So typically you're buying instruments inside of your retirement account, whether that's an IRA, a 401k. You're buying instruments that hold investments, right?
Right.
And you have to pick those instruments, you have to pick those products in order to participate in those. Now that's the 401k. IRAs work a little bit different, right? Because you can actually hold investments.
Right. And I like that example that you give of the wrapper, right? Whether it's a mutual fund or it's an ETF, electronically traded fund. It's an ETF is another type of, you might say, mutual fund. Keeping it very simple, but you don't own the candy bar, you own the wrapper. And the company whose name is on the candy bar actually owns the candy bar, but you own the wrapper, and because you own the wrapper, you have a certain claim to what that, maybe you get a little piece of that, but that's good illustration. Yeah, exactly. There you go. So you're listening to Financial Strategies with Andrew and Daniel Agemy. Time for us to take a break, and this Father and Son team is coming to you to be able to help you to know what you don't know so that you can make smart decisions in your retirement or for your retirement. There's a lot of things going on out there in the world today, a lot of information and a lot of misinformation, but we're trying to give you the straight scoop here. And today, in order to be able to help you with this, we have a book that we'd love to be able to put in your hand for that. And this is a simple read book called The Richest Man in Babylon. And this goes back to some scripts that they found in the 30s and scrolls and things that they found back from Babylon hundreds of years ago. And so we'd love to be able to put this in your hand for free by calling us at 800-725-7616. Next 5 first-time callers, 800-725-7616. And we'd be glad to put this into your hand as we are able to confirm that mailing address. So 800-725-7616, call now.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to agemy.com for your free retirement review. That's AGEMY.com. The Retirement Income Store, where retirees go for income.
Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
So Daniel, earlier I talked about registrations, IRAs and such, talking about like registrations and like license plates. And I have this license plate that it said, the license plate says FORSALE, for sale. and it's pretty cool. License plate gets some looks, and people say, "Is that a real license plate?" And right now, that license plate is sitting on the shelf, not doing anything. And that for sale is the equivalent of an account number for your IRA, right? And this would be sitting on the shelf, not doing anything. But I can take that license plate and I can put that on a Mustang in the summertime, and I can have some really great performance from that. And then in the wintertime, I can take that license plate that says for sale, I can put it on a four-wheel drive pickup truck so I can plow the driveway and different things like that. And it's a different kind of performance. It's doing a different thing. It's more purposeful than performance, right? Because it's fulfilling a purpose of getting me through the snow, getting the snow plowed. But that registration is not the key as much as it's more of an account number saying what the rules are, where the vehicle itself is what's working for me in that example. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about investment vehicles. And we're talking about license plates. And what do you know about license plates? What do you know about investment vehicles? No, that's pretty good. That's pretty good what you're going there because there's restrictions also, right? There's restrictions to what types of plates you can have on what types of vehicles. So like a passenger car, you can't put on a tractor trailer. So in your 401k, you can't own individual bonds, right? You can't own these tough, solid, dependable things like the tractor trailer, right? So there's different things. You have that license plate number, which is like an account number, and there's rules what types of things that can go on, what types of investments you can hold, or it could just sit on the shelf and do nothing. Now, here's one time you might think that procrastination was a good thing, is if you started your 401k at the beginning of the year and you forgot to invest in anything and it's all sitting there in cash. You might be pretty happy about that.
Yeah.
But typically, your dollar cost averaging in over a long period of time, right, with the 401k. And so that it doesn't affect you so much. But if you did procrastinate, go check it out because you might be happy. You might be able to get some good deals.
Right. Exactly. That's a beautiful example there with that. And, but when we're talking about these IRAs versus investments, right, that again, the IRA is not what you're invested in. IRA is just saying how you can invest that. And like Daniel, you said in regard to the license plates, right? In Connecticut, we have passenger plates and we have commercial plates and we have combination plates, and they do different things and can go on different vehicles. And that's kind of like the difference between IRAs and Roth IRAs, right? And 401ks, and they do different things, right? And just really quickly here for the people in the audience, traditional IRAs are where you can if you can contribute to it, you can put money in and you get a tax break on it. So then the money is growing tax deferred. And the concept is that you take it out of retirement, and at retirement, you'll be quote unquote in a lower tax bracket. Well, the IRS lied to us, and a lot of people are not in a lower tax bracket. They're in the same, or sometimes they're in a higher tax bracket. Then we have, because taxes are important, right? There's the Roth IRA where you put money in, you pay the tax when you make it in your paycheck, put the money in the Roth IRA, and then the money grows on a tax-free basis and you can take it out tax-free. So you get the tax break on the back end on the Roth IRA, you get the tax break on the front end on a traditional IRA. A non-deductible IRA is one that you're able to put money in and there's no deduction for it, but it grows on a tax-deferred basis. Then the rollover IRA is what you roll over your 401k into an IRA from that standpoint. And a lot of times we just use regular traditional IRAs as rollover IRAs, but rollover IRA is something that language that is out there and people are using it. So I want to let you know it's from really a lot of times there's not any significant difference between a rollover IRA and a traditional IRA if you're rolling for your 401k over into that. So that's some of the things that are going on with IRAs. And with Roth IRAs, there's two ways of getting money in. One is through contributing if you have earned income. The other, and meet the guidelines, the other way is for converting IRA monies into Roth IRA monies. And Daniel, seems like I'm missing something here when we're just talking about the differences between IRAs and Roth IRAs and that kind of thing. Well, what am I missing?
Well, the tax-free nature, right? So the Roth IRA is something that you put your money into it and you'll never pay tax on it
Which is
again,
beautiful. Yeah.
which is an amazing thing when you think about, the debts, right? Our country has $31 trillion of debt now, but that's not the off balance sheet liabilities. It's like 170 trillion or something, some ridiculous number if you count about,
Ouch.
you know, the off balance stuff, the the social security that's owed, right? The
Yeah.
Medicare that's owed, all these benefits, the things like that. So taxes are going to have to go up if we want to start, whittling down some of this debt.
Yeah.
Um, and so the tax-free nature. The other is typically a 401k or an IRA, right? You could do a Roth 401k. Typically, that's where people's they have generated, they have built most of their wealth.
Yeah. And the 401k. Yeah.
And so if you can grow that, if you can contribute, say 200,000 and it's worth 1 million over a period of time, do you want to pay taxes on the million when you only contributed 200,000? Or do you want to pay tax on 200,000 and get the million being able to be used tax free?
Right.
That's the difference, right, between the IRA or a traditional IRA, traditional 401k, and a Roth 401k.
Right. Right. Exactly. And, um, if it's tax free, it's for me, right? I mean, when is $1,000 not $1,000? When you have to pay tax on it and you end up with 700 out of that $1,000. So I love the tax free approach. And when you're talking about wanting to keep us in inflation, tax free is a huge way to keep up inflation, especially as tax rates rise as time goes on and whatnot. You're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. This father son team is dedicated to educating you and helping you to understand things in a way that are typically not communicated. So today's topic is IRAs versus investments. They're two different things. And we're glad to be able to educate you on this. I have a paper that I'd love to give to you that we put together for today's show, Investing for Income in the Stock Market. Investing for Income in the Stock Market is this paper, and it will be able to help you to be able to understand how to deal with things from that standpoint, and how you can invest, how you can make money. So I'd love to put that in your hand by calling 800-725-7616, 800-725-7616, and for your free copy of that paper. So call now. Daniel, when we're looking at these things, investments, a true investment, as you've said so many times in the past, is something that pays you. So we've talked about registrations and how the rules of the IRAs, 401ks are one thing, but people don't put money into 401ks and IRAs and such just for the rules. Typically, they want to make money, right? They want to grow their money. I mean, we have one client who said, Andrew, I invested my money in the stock market for, I think he said, like 13 years. And when I took it out, I had like $300 more than what I had put in over that period of time. Right. He was in the market, and he was dollar cost averaging. He was doing all the things, but he calculated it and he just got his money back. That's an egregious situation. But, a lot of that is because people don't understand the definition of investments. And when people think they're investing, when they're really speculating, right?
Yeah, there's a lot of things. There's these types of accounts can be a big illusion, especially for like business owners, I would say, or people that have unpredictable, maybe salespeople, people who have unpredictable incomes. Because what happens all the time? 401ks have built people so much wealth because the money comes out of their check, they forget about it, and
Yeah.
then it dollar cost average into something like the S&P 500. And the S&P 500, if you participated in all of the dips, now not if you held it, if you just held it for the last 20 years or 22 years, you wouldn't have done especially well, right? You would have compounded at about 6.25, which is nothing. for the amount of risk you're taking on, that's nothing to be super excited about, because you could have bought 7 or 8% bonds
Right.
20 years
Right.
ago
Right.
and just rode those the whole way and not had those dips. But if you participated in all the downturns, that's where you really get the compounding. Now, the difficulty is people have real lives. And if you lose your job, you typically lose it when markets are down. If
Yeah.
you are a salesperson and you didn't lose your job, but sales aren't good and you need to support your lifestyle when stuff's down. If you're a business owner and you need to borrow the company money, or you need to expand and you're
Right.
the only one, you're going to support your company so you can grow, right? Typically those happen at the most inopportune times. And what do people
Yep.
end up doing?
Selling.
Liquidating their
Yeah.
stuff at a loss so they can do these other important things. And so that's where, I don't know the story you're talking about if something like that happened, but that's the problem. Everybody looks at a 40-year period and says, look at how great the markets did. And that's true if you didn't touch the money or you kept investing. So you have to balance life and investing, right? There's
Yeah.
a balance. We have this conversation all the time with people.
Right.
You're not guaranteed tomorrow. You're not guaranteed 40 years down the road, but you also might live to be 120 years old. So there has to be this balance between living now, saving, but also investing in a wise way where it can last and it can protect you. You can have something if you live to be longer than you were expecting.
Exactly. Yeah, I agree. And when you were talking about all those different things, then you have the situations where I just spoke with somebody recently who, they left their firm several years ago, their old firm, and they left their money in their 401k. And the money is not working right now. It's at a loss because they don't have that dollar cost averaging, that money going in from their paycheck right now, and they're actually losing money, and they don't think about it in those terms. And the market has come down 15-20% or so. I mean, the market has to go up somewhere in the 25% range just to break even for them. So that's painful to me to see people losing money, and they think, oh yeah, but it's okay, it's my 401k. And but people don't understand that a true investment is something that's supposed to make you money. It's something that you get paid for. You get paid on. So you're listening to Financial Strategies with Andrew and Daniel Agemy. We're going to talk more about this difference between IRAs versus investments. And we hope that you stay with us with this. We're going to have to take a break, but we have a book that we'd love to put in your hand in the meantime. It's called The Richest Man in Babylon. Easy read book that will give you a lot of good advice for being able to plan ahead, to be able to save money, and to be able to invest it in a proper way. Believe it or not, even back then in Babylon, they can tell you we can learn lessons from how they invested money. So call now, 800-725-7616 to the next 5 first-time callers, 800-725-7616 for your free copy. Call now.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at agemy.com. That's AGEMY.com. Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
So Daniel, I know this guy that, he wanted to invest in real estate. So what he did was he sunk $25,000 into the wrapper of a real estate deal, not the actual candy bar, but he bought the wrapper, right? He met this guy at one of his business meetings that the guy was investing in real estate, making some money, and having contracts with different real estate investments and such. And so he gave the guy $25,000, and guess what? The wrapper got thrown away. He lost all his money, right? Today, that man is looking about having those contracts himself directly so that he can get paid. It's kind of like the difference between, in FanDuel fantasy football and Robert Kraft, right, who owns the New England Patriots, right? So Robert Kraft is investing his money. He's getting paid all the time on the New England Patriots, but those people in FanDuel, they're not, and it's a speculation. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about IRAs versus investments, and it's the part of the show where we get a little bit into the investments and what is an investment. So you're saying you got a guy, and this guy thought he was buying a contract, but really he was buying somebody saying he was buying a contract. That kind of reminds me of this FTF thing going on, where people thought they were putting their investment, their crypto, their speculation into an account that was actually holding what they thought they were owning. But you had Sam Bankman-Fried going over there, taking their money and buying politicians and buying judges and buying whatever he felt like it, Bohemian property for his parents and his friends with people's money. So that's the problem with not owning your contract, right?
Right, exactly. It's huge, right? Well, gave that illustration earlier of owning not owning the candy bar, owning the wrapper for the candy bar, and that there's a lot of speculation with that. Like you also said, you get some of the crumbs with that, and so we have to be careful that when we're investing, is it true investing, or do we just say it's investing? Right? Because, a lot of people put money in their 401k plans and they think they're investing, but are they really? And that's what we're going to be talking about at this point, right? Do I have that right? Your definite, whenever we're talking about investments, you define it as something that pays you, meaning
Right,
that you actually get money. Right.
Yeah.
It has to pay you to be a true investment.
You have capital. You have hard-earned capital, and you have choices what you want to do with the capital. Now, you could give it to somebody and say, well, I mean, that's what that book is, right? We're giving away that book today, and it explains what an investment is.
Right.
What an investment is, and it explains, like, the strategies behind investments haven't changed. An investment means it pays you. You take your hard-earned capital, you lend it to somebody, you let someone use it in return for a gain, right?
Right.
Now you can speculate and you can say, well, I hope that this goes up, or I hope that this over time, this has always gone up. Over time, housing has always gone up. So when I buy my house, that doesn't pay me anything. It's actually a lot, right? It's costing you money because you have to invest into your house. That's an investment. People use that term all the time. Your personal house is not your investment.
Right.
It's not paying you. You're speculating that the price will go up more than inflation. Otherwise, it's just keeping pace with inflation, and it's not actually doing anything for you. And it costs a lot of money to have a house.
Right.
That's an example compared to real estate. If you bought a commercial property, you bought an apartment building, that is paying you. You say it's going to cost me this much, and it's going to pay me this much. And you get to decide if that's an investment you want to participate in, or if it's not an investment. How are you going to decide if the house is going to go up in value? It's just, is the Fed going to keep printing money and drive prices of everything up, or are they going to stop printing money?
Right. I like that. I like that real estate analogy there, because you buy a piece of real estate that you rent it out, and every month you're getting money. It's paying you every month. You get those rents coming in, and and over time, you own it long enough, you'll get back all of your money that you paid for the property, plus you still have the property that's worth something, and generally speaking, goes up in value. So that's a great analogy with that. Want to let you know, if you just joined us, you're listening to Financial Strategies with Andrew and Daniel Agemy, and this father and son team trying to help people to know what they don't know so they can make smart decisions. Today's topic is IRAs versus investments. A lot of people don't understand the difference between IRAs and investments. An IRA is the registration or the account number, we'll call it, and the investment is actually what you're actually investing that money in. So two different things, just like the difference between a license plate and a motor vehicle. So we have a paper that we'd love to give to you as we talk about today. It's called Hard Lessons of Stock Market History. There's a lot of things we can learn from stock market. One of the best ways to get experience by learning from the mistakes of other people, and you can learn from the mistakes of stock market and what happened in the stock market over the history of the stock market. We'd love to put that in your hand for free, no obligation, calling us at 800-725-7616 for your free copies. Just ask for it by name, Stock Market History, or you can check us out on the web at agemy.com, AGEMY.com. The two words Agemy, spell our last name Agemy, and you'll be able to just contact us through the website to be able to ask for your copy of Stock Market History. Daniel, as we continue to talk about investments, so I think hopefully people have that idea that investment is something that pays you, and if you're, a lot of times people think, well, it's paying me because my account value is going up. Well, right now, people's account values typically are not going up from where they were a year ago. And, the illusion that's going to happen is next year, right? So come January 1st, right, we reset things, right? The markets come down 15%. And when on January 1st, everything got reset. And so now in September of the new year, right, then people's account balances might say plus 10%, but they're not back to where they were in January 2022. So, that's an illusion that comes in when we're talking about investments here. And maybe you don't want to get into that now or not, but, I want to throw that in.
Yeah, well, that has to do with the math behind gains and losses, right? And we try to stay away from math on these shows because people are trying to listen and they're trying to do that. But the math behind it is, if you go down 30%, if you go back up 30%, you're good, right? No, that's not the way the math works. You have to earn 42%. So if you went down 30% this year,
yeah,
and your account says you made 30% next year, you're thrilled to death. You're going and knocking on your neighbor's door saying, look, I made 30%, right? You're telling the world, I'm the smartest investor ever. I made 30%. Look at how good I'm doing. And guess what? You're not even back to even.
Right.
Because you have to make 42%, 42.9%, just to get back to even. And it gets more and more exponential as the losses are bigger.
Right.
The 30% is something that we've seen a lot of people losing this year. And so that's why I'm using that number. But that's an illusion, right?
Yeah. Yeah.
Now, is speculation bad? Well, it's like motor vehicles, right? We can go back to your motor vehicle analogy. Is an electric vehicle bad? Is a hybrid bad? Is a little tiny smart car bad? Is a huge truck bad? Right? Well, what are you using it for? What do you want? Some people want a showpiece. They want a car that they're going to buy. They're going to buy a Lamborghini. They're going to show it off. They don't really care how expensive it is. They don't care about the fees. They don't care about anything. They just want to say and show they have a Lamborghini.
Right.
Some people are going to buy a little tiny car that doesn't cost a lot of money. It doesn't have a lot of fees. It doesn't cost a lot to operate. It doesn't cost a lot to insure. And they don't care that it's not a showpiece.
Right.
Some people are going to buy something that they can use for driving Uber and earning income, and they're going to earn an income from their vehicle, right? Some people are going to buy a truck to pull a trailer so that they can deliver vehicles or do whatever they need to do, right? And earn an income from it. So just like your analogy with the license plates and the vehicles and the registration, investments are the same. You get to decide. Now you need to understand how these things work enough to make a smart decision. But every vehicle isn't right for every person.
Right.
And every investment is not right for every person.
Right. And when you're looking at people who are in and close to retirement, their situation has changed, right? Most of the time they get to that point in a two-seater sports car, very performance oriented, but then at that point, they have to change to a purpose orientation so that they make sure that their purpose of having all the money that they need to be able to last the rest of their, all the income that they need to be able to last the rest of their life is a significant aspect. And so, we always have to match up the purpose with the right situation, whether we're buying vehicles or we're investing or whatever case may be. And part of that, when it comes to investing, is the risk versus reward, which I'd like to maybe get into that, Daniel, a little bit in our next segment. Right now, we're going to need to take a break. But people don't think in terms of risk versus reward. And I hope that you and our listening audience will join us after we come back from break. But in the meantime, I'd like to give away this book. Lessons from Babylon, right? The Richest Man in Babylon. Great read, easy. Glad to be able to give this to you to be able to help you understand in a clear perspective of how to do these things and how to be able to invest for the future. You can have this be one of our next 5 callers calling for the first time at 800-725-7616. Call now.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at agemy.com. That's AGEMY.com. Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
So Daniel, as we talk about investments, and I alluded to earlier a little bit in regard to the difference between Robert Kraft, who owns New England Patriots, and FanDuel or fantasy football. And, Robert Kraft owns the Patriots, and he has contracts with the general manager and with the coaches and the players and that kind of thing that he's making money on. There's not a lot of guess. He has control over that situation. For if he doesn't like the coach, he can fire the coach, or he can hire new players, or whatever he wants to do. He has control. Whereas the FanDuel or the fantasy football participant they're just hoping they got the right mix, right? They're hoping that there's no control on that situation. And that would be a lot like somebody that owns the wrapper of a mutual fund, the wrapper of the candy bar. They don't own the candy bar, they own the wrapper. Then they don't have any control on it. Whereas in that example, Robert Kraft owns the candy bar and he has the control on that. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about IRAs versus investments. And the IRAs, the 401ks, these types of things have rules to them. And I think that's maybe what you're getting at, because there's certain rules that you have to follow. And it's based on those arrangements. So if you're invested in your 401k, you've got to obey those rules. And you have to own those things kind of sort of owned by wrappers, right?
Right.
The way our financial system's set up, you can't really own anything outright yourself, but you can get closer and closer to owning the underlying asset, right? So if you bought a corporate bond, for example, then you have a right to that company's assets, depending on what you get in the structure of the bond. You should be checking what kind of rights you have, right? What kind of covenants are in there to protect you. And you buy a stock in a mutual fund. You buy a mutual fund that owns stocks. You'll basically own nothing, right? BlackRock owns the stock. The stock just represents cash flows. It doesn't represent, like, if the company has issues and it goes down, they go bankrupt, what do you get? Nothing. Right? And this is another one of those myths where people talk about risk versus return. Okay. So did you realize you were taking on that kind of risk when you bought the stock? Okay. If you go down 60%, how much money do you have to get back to even? 300%, right? 300, or I'm sorry, 150%. You got to go up 150%. What's the likelihood of that happening? How many people have made 150%,
Right.
right? In any kind of reasonable amount of time.
Right. Right. Exactly. Exactly. And that's just getting back to even.
Right.
That's not even making money on it.
So these are the kinds of risk returns. So in the 401k, you're only able to participate typically in these kind of wrappers, right? And the wrappers also, so in that's designed for growth, that's designed for speculation for young people to build wealth, and you don't really care about the downturns because you don't need the money. You're not supposed to touch the money.
Right.
And the downturns mean you're buying more assets. You're buying shoes on sale for 50% off. You're buying, beef at the butcher's market for 50% off, right?
Right.
So that's what you're signing up for when you're buying these kinds of things. And you need to understand that. That's the way that those things are designed to do. Now, as you get older, as you mature, there's other options available to you.
Mm-hmm.
Right?
Right. Right. And that is, options are always good, right? And within 401k plans, you have typically a lot of options, but unfortunately, the options tend to be more speculative than true investments. And then, one of the things is, you typically have some bond funds and some stock funds and maybe some other variety funds, which is fine. But if you're going to invest your money and you're going to be aggressive, well, make sure your investments are aggressive, that they can make you something as the markets go up. And many times people invest in bond funds to protect themselves. But in my methodology, my way of thinking, you're better off investing in the stock funds. But that's a whole nother thing. But you have to look to see what's the risk versus the reward. What are you getting? What's the potential here versus what you're risking? And today, I believe a lot of people are not recognizing that idea. What is the risk versus what is the reward? Today, people are getting an average in the stock market over the past 20 years or so, 6%, and they think that's a good return. Well, is it really, when the risk-free return right now is 4% for a treasury bond? I mean, if I could buy a treasury for 4 and get 4% on it and risk my money and maybe make 6% average, that's not a great return. So we'd love to be able to give you more information on this. And we're going to, let me just say, you're listening to Financial Strategies with Andrew and Daniel Agemy. And today's topic is IRAs versus investments. We've been spending a lot of time on the investments side, and I have a paper that I'd love to put in your hand called Investing for Income in the Stock Market. There's ways that you can invest in the income in the stock market in things that will actually pay you. And we'd love to put this in your hand so that you can have a true investment. And call us at 800-725-7616, 800-725-7616 for your copy of Income in the Stock Market. All right. And call now for that. You listen to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. Daniel, this risk versus reward thing, you were telling me how a lot of money managers and so forth, they understand that, but a lot of the retail public, people who have 401ks and IRAs and such, don't understand it as clearly as they should.
Right. Well, there's a lot of ways to look at this. And the crazy thing is, not too long ago, this wasn't even a calculation, like risk adjusted return, or how much risk am I willing to take on for the return. And so people will say things like, well, we need to be aggressive. Well, what does that mean? Right? You talk about definitions all the time, and different people have different ideas of what aggressive is. Is aggressive buying a variable annuity inside of your 403b? Is that aggressive? Well, I mean, I guess it's aggressive on the downside because you could lose a lot of money in it.
Right.
And then it's got those fees. That's the thing. You always have to watch out for fees, right?
Yeah. Right.
Because if your account goes down, we talked about Jimmy John a few weeks ago, who had $1 million IRA. He lost 60%. It was worth $400,000.
Yeah.
And he had to take his RMD out. right? So you had
Right.
to take 10% of the account out in
Mhm.
order to cover the RMD. He's not getting back to his $1 million, right?
Yeah.
Or if you have that BlackRock fund that's
Yeah.
charging you
Two and a half.
2 and a
Yeah.
quarter,
Oh, 2.25.
the 150% to get back to even is not going to help you out. Depending how long you've been down, that 2.5% to 2.25% is going to really eat up your funds, right?
Exactly.
So you have to understand, what risks do you want to take? We had somebody come in the other day, who had a fund, and he was down, and he was like, well, I think it's a good setup, but I'm down, so let's sell, and then when markets start going back up, we'll buy back in. No, it's not how it works, right? That's not how it works. That's the opposite of what you're supposed to do. So you need to understand what type of vehicle you want to drive.
Right.
You need to understand the right thing for you. And that's like the risk and the return, right?
Mhm. Mhm.
People will say, let's get aggressive, and they're talking about buying the S&P 500.
Right.
Now, the S&P 500 has, over 40 years, has done a reasonable return, but it's not like a spectacular return, right?
Right.
I think
Exactly.
when we looked it up over 150 years, it was somewhere around 9%.
Right.
9% is pretty good, but it's not spectacular, right?
Right. I get it.
Especially because a lot of times throughout that period of time, I mean, there was a time during that you could get a CD for 18%.
Right.
So like the 9% is not spectacular when you could have got during that
Right.
time 18% on a
Right.
CD, right? So that's what we're talking about, risk and return. So you need to understand where your objectives are and what your goals are for the money, right?
Right. Uh-huh.
And then you can look at different strategies. So in the 401k, you're limited. When you're 59 and a half, a lot of times the 401k company will allow you to roll that over where you can participate in other things, and you can actually own the contracts behind the investments that you're
Right.
purchasing,
Oh,
right? And
yeah.
that's a game changer.
Indeed.
So do you want to earn 9% or 6%? It's 9% over, I think, 150 years, 6% over the last 22 years, 6.25. Does that sound like a good amount of return for having 40%, 35% drawdowns or more in that period of time? That doesn't sound good to me. Now, if you're dollar cost averaging, maybe you like that, right?
Yeah.
But
But
that's not the kind of risk adjusted return you want to take on, right? You know what sounds like a much better risk adjusted return would be kind of some of the corporate bonds that would be available right now, where you could get 7% and you have a contract backing it up. They're going to pay you that. Now, you could
yeah.
do better than that because you're buying them under par,
Yeah.
but you know you're going to earn that 7%. You know what also sounds better? If you want to get aggressive and you want to be risky, why don't you look at some of these emerging markets like India that has an amazing demographic right now? They have one of the most educated populations, right?
Yeah. Yeah. Very
And they're
smart
building
people.
this infrastructure,
Yeah.
getting ready to pop. There's other emerging markets where their demographics are getting ready to pop, right? They're very
Mhm.
educated. They have all the things you need for a good booming economy. Whereas you look at the S&P and it's come down, what, 25% year to date, and it's still overpriced. Why would you take that kind of
Yeah.
risk when you have these other types of risk where you have a much higher upside, right?
Yeah.
That's we don't have enough to get into a depth, but that's the kind of thing. What's my upside versus my downside? Now, you go buy Apple, you go buy Tesla, they're both down big time already,
Mm-hmm.
but they have a lot more they could come down easily, right?
Right.
And how
Right.
and they don't, like, where's the upside? Like,
Right.
people think they have all this upside, but where's the upside? Like, Apple's going to double or triple their phone sales. They're going to go into electric cars and right. So yes, it can earn more money and people have done really well on it. But do you have like this exponential upside for the amount of risk you're taking on where it could come down
Yeah.
50%? It could come down 40% pretty easily.
Right. Well, people tend to think about what has happened in the past, and they think that that's going to be an indication of what's going to happen in the future. And unfortunately, that's not the way things work all the time. You have to be an educated retiree. An educated retiree is a happy and stress-free retiree. And that's at Financial Strategies with Daniel and Andrew Agemy. That's what we're trying to do, is educate retirees and pre-retirees so that you can be happy and stress-free. In order to continue that education, we have this book for you, The Richest Man in Babylon. We'll love to give this away as we finish up the show for today. We appreciate you joining us. If you want a copy of this, be one of the first 5 first-time callers at 800-725-7616 for your copy. 800-725-7616 for your free copy. No obligations. Call now. And please remember this. If you want your retirement to be stress-free, invest for the I and not the G.